In your 40s, making wise financial decisions takes on greater importance, and avoiding certain common money mistakes is critical to long-term financial success. Let's uncover these 8 pitfalls that have the potential to disrupt or kill your financial progress. Number 1. Overspending on your kids. Overspending on your kids while in your 40s can be a significant financial mistake with long-lasting consequences. While it's natural to want the best for your kids, excessive spending can lead to financial strain and undermine your own financial well-being. Overindulging in unnecessary expenses like lavish vacations, extravagant gifts, or overspending on extracurricular activities like tutors, traveling sports teams, competitive dance troupes, or summer camp can lead to accumulating significant costs over time. While it can be difficult to say no to everything your kids' hearts desire and your desire to want to provide those things for them, it's important to find a balance between providing for their needs and maintaining your own financial goals. These goals could be saving for retirement or building an emergency fund. According to this article on LendingTree, 8 out of 10 parents admitted to going into debt to pay for their kids' extracurricular activities. Consider taking time to reassess your money values as a family and teach your kids about creating their own value system, including setting reasonable boundaries with spending. Number 2. Buying a bigger house than you need. While it is tempting to upgrade to a larger home with more square footage, a larger yard, and in an upscale neighborhood as your income and family size grows, it's important to consider the financial consequences. A bigger house typically comes with higher mortgage payments, increased property taxes, and higher maintenance and utility costs. These expenses can put a strain on your budget and limit your ability to save for other important financial goals like retirement or education expenses for your kids. Moreover, a larger house may require more time and effort for upkeep, leaving you with less flexibility and freedom. It's important to determine your actual needs and consider the financial impact before deciding on a new home. Prioritizing a home that fits your needs and budget ensures you maintain financial balance and have resources available for other important priorities. Number 3. Not having insurance or lacking adequate insurance. Not having insurance in your 40s can be a huge financial mistake that leaves you exposed to unexpected losses and risks. During this stage of life, you may have acquired assets such as a home or vehicles and have dependents who rely on your income. Health insurance is essential to protect against high medical costs, while life insurance provides financial security for your loved ones in the event of your untimely passing. Remember, the cost of opening a new life insurance policy goes up with age, so it's best to start with a good policy as early as possible. Homeowners or renters insurance protects your property, and disability insurance helps replace lost income if you become unable to work due to injury or illness. By neglecting having the right insurance coverage, you risk significant financial hardship and going into debt. Prioritizing having the appropriate insurance coverage is a wise decision that ensures peace of mind and protects your financial stability. Number 4. Not doing estate planning. Failing to do estate planning can be a serious financial mistake that leaves your assets and loved ones at risk. According to this article on CNBC, 2 out of 3 Americans procrastinate creating an estate plan. Estate planning involves creating a will or trust that will determine where your assets end up in the event of your death. It also involves establishing power of attorney and other important documents like advance healthcare directives. Without a clear plan in place, your assets may not be distributed according to your wishes, leading to potential family disputes and legal complications. There is also a higher risk of your estate ending up in probate, a process that can be expensive, time-consuming, and intrusive. Court costs, attorney fees, personal representative fees, bonds, and accounting fees all add up. Also, estate taxes can drain your estate, leaving your loved ones with a much smaller inheritance. By neglecting estate planning, you miss the opportunity to protect your assets, minimize tax liabilities, and ensure your loved ones are taken care of after your passing. Engaging in estate planning in your 40s provides peace of mind, preserves your legacy, and helps secure the financial well-being of your family. Number 5. Using retirement funds to pay for college. While it's natural to want to support your kids' education, it's important to prioritize your own retirement savings. Taking money out of your retirement accounts can have long-term consequences, such as reducing the growth potential of your investments through lost compounding, and potentially incurring early withdrawal penalties and taxes. Remember that there are alternative ways to finance education, such as scholarships, grants, student loans, or encouraging your kids to contribute through part-time jobs or applying for financial aid. The reality is that your kids can borrow money for college, but you can't borrow money for retirement. You're setting your kids up to have to support you in your old age, right when they will likely have young children of their own. By preserving your retirement funds and focusing on saving for your own future, you can ensure financial stability in your retirement years and provide a solid example for your kids to manage their own financial responsibilities. Let me know in the comments if you like this video and would enjoy more content like this. Number 6. Carrying high credit card balances. High credit card balances often come with sky-high interest rates, leading to mounting debt and increasing financial stress. The longer you carry a balance, the more interest you'll accumulate, potentially resulting in a never-ending cycle of debt. According to an article on CNBC, Americans between the ages of 40 to 49 carry the highest amounts of credit card debt at an average of $7,600. High or maxed out credit card balances make your credit utilization percentage skyrocket, and credit card utilization is one of the biggest factors that affect your credit score. Plus, as soon as you miss a payment, late fees and additional interest may start to pile up. This will negatively impact your credit score, making it harder to secure loans or obtain favorable interest rates in the future. Also, high credit card balances can hinder your ability to save for retirement, invest, or achieve other financial goals. It's important to prioritize paying off credit card debt on time and develop a budgeting plan to avoid excessive reliance on credit. By practicing responsible spending habits, you can improve your financial health and build a stronger foundation for your future. Number 7. Not having an emergency fund or not funding one regularly. Life can sometimes be full of unpredictable events such as a job loss, medical emergencies, or major home repairs that can happen at the worst possible time. Without an emergency fund, you may be forced to rely on credit cards, loans, or other high-interest forms of debt to cover these unforeseen expenses. This can lead to a vicious cycle of debt and financial stress. According to an article on Bankrate.com, over half of Americans reported feeling uncomfortable with the amount of emergency savings they currently have. Having an emergency fund allows you to handle these unexpected situations, providing a financial safety net and allowing you to cover essential expenses and maintain your financial obligations during difficult times. Aim to save 3 to 6 months' worth of living expenses in your emergency fund to ensure you are prepared for any financial setbacks. Consider scheduling automated regular savings into a separate account that you don't regularly access. By having an emergency fund, you can protect your financial well-being and avoid getting into unnecessary debt. Number 8. Not taking care of your health. Your health directly impacts your overall well-being and can have a substantial financial impact. When you ignore your health, you increase the risk of developing chronic conditions or facing medical emergencies that can result in expensive medical bills, ongoing treatment costs, and potentially impact your ability to work and earn income. Poor health can also lead to decreased productivity, missed workdays, and potential career setbacks. Untreated health issues can become worse over time, requiring more extensive and costly treatments down the line. Per this CNBC article, Americans can expect to have to pay more in healthcare costs as they reach retirement years. Investing in your health through regular exercise, a balanced diet, preventive screenings and regular checkups, and maintaining a healthy lifestyle not only improves your quality of life now, but also helps minimize medical expenses down the line, protecting your financial stability. Avoiding these 8 common money mistakes in your 40s is critical for building a solid foundation of financial stability and security. By being proactive and avoiding these financial pitfalls, you can pave the way for a more secure and prosperous financial journey throughout your 40s and beyond. Thank you for watching. Comment below which other money mistakes one should avoid in their 40s. Also, check out my other videos on money mindsets. Like the video and subscribe.